Welcome, ladies and gentlemen, to Lesson 11, Capital Budgeting Decisions. In this lesson, we're going to learn how management uses net present value and discounting cash flows in the capital budgeting process. We're going to go through various examples of calculating net present value and discounting cash flows using different variables. Then we're going to learn different types of analyses that management use to make decisions, including least cost method, total cost method, incremental cost method, payback period method, and simple rate of return method. First, we want to go through some concepts and definitions. The concepts and definitions for Lesson 11 are actually on the back of Lesson 10 cheat sheet, so have that cheat sheet in front of you. We're going to go through these concepts and definitions pretty quick. We got three equations here in so it's pink color. We got profitability index. Profitability index equals present value of cash flows over investment required. Down here we got simple rate of return. We got annual incremental net operating income over initial investment equals simple rate of return. We got payback period. Payback period is equal to investment required divided by net annual cash flow. Okay. Capital budgeting decisions concerning major capital assets, including projects, production facilities, machines, land, other assets. Typical decisions include cost reduction decisions, expansion decisions, equipment selection decisions, lease or buy decision, and equipment replacement decisions. There's screening decisions. Screening decisions require management to evaluate a proposed project or evaluate whether a proposed project passes a preset hurdle. And preference decisions require that management select among competing courses of action. Now, net present value. Net present value equals the difference between present value cash inflows and present value cash outflows. If the net present value is positive, then the project is acceptable. If net present value is 0, then the project is acceptable. If net present value is negative, then the project is not acceptable. Over here to the left, the time value of money concept recognizes that a dollar today is worth more than $1 a year from now. Discounted cash flows. Discounted cash flows, the best way to recognize the time value of money concept in a decision is to calculate discounted cash flows. Least cost decisions. Those decisions are decisions where revenues are not directly involved. Managers should choose the alternative that has least costs from a present value perspective. So, least cost decisions, when we're trying to make a decision between a project or an acquisition, and we can't directly attribute revenue, the way we make the decision, or the best way to make the decision, is calculate the net present value of the cash outflows, and the least cost is the best alternative. The incremental cost approach. Under the incremental cost approach, only those cash flows that differ between the two alternatives are considered. That's sort of like our relevant, irrelevant decisions, but we take those relevant decisions, not relevant, irrelevant decisions, relevant, irrelevant costs. In the incremental cost approach, we take the relevant costs and we present value them. So that's similar to the lesson 10, but in this lesson we present value those costs. Typical cash inflows are salvage value, reduction of costs, or incremental revenues, releasing of working capital. Typical cash outflows are repairs and maintenance, initial investment, incremental operating costs, working capital. Cost of capital. Now, the cost of capital, usually regarded as the minimum required rate of return and typically the average rate of return the company must pay to its long-term creditors and stockholders for their other funds. Okay, cost of capital. That's going to be the percent that we use in our discounting model, or the present value factor that we're going to use. The cost of capital, the cost that is the cost to us of borrowing money or taking money from investors, or an internal required rate. So that's going to be the present value factor that we're going to use. Payback method. The payback period is the length of time that it takes for a project to recover its initial cost. When we had that equation down below, simple rate of return. That's the simple rate of return method, also known as the accounting rate of the accounting rate of return, or the unadjusted rate of return. The simple rate of return doesn't discount, doesn't take into consideration the present value, but it does not focus on cash flows. Rather, it focuses on accounting net operating income. All right, now find your Lesson 11 cheat sheet, because the Lesson 11 cheat sheet has all of our examples. Now, let's go to the top left of the Lesson 11 cheat sheet, and we're going to start with a net present value method example. 1. HMS Round Belly Inc. has been offered a 5-year contract to provide mast mounting parts to a large manufacturer of commercial schooners. If Round Belly were to accept the contract, it would require investing in the new equipment. The contract will guarantee Round Belly $1,250,000 in sales revenue per year. Round Belly management has also gathered the information below regarding the contract. All right, based on the discounted cash flows, should Round Belly management accept the contract? Okay. So this is a simple decision where we're going to take the net present value. If the net present value of the cash flows is positive, then it is an acceptable contract to take. All right, so we're going to go through all of the sort of light blue boxes here. The first one, cost and revenue information. Cost of new equipment, $1,436,500. Working capital required is $450,000. Significant scheduled maintenance year 3 is $30,000. Salvage value of equipment in 5 years is $250,000. Annual cash revenue and costs. Sales revenue, as we said before, is $1.25 million. Costs of parts sold per year is $562,500, and salaries and shipping, etc., per year is $250,000. So in the blue box below, we're going to calculate our annual net cash flows. So our annual net cash flows is going to be our sales revenue less our cost of parts sold, less the salaries and shipping, etc., costs that would be included in accepting this project. So moving to the right, to the light blue box, we're going to say, what are our annual net cash flows for this project? What we're going to do is we're going to take if we have annual cash flows, we need to come up with an annuity factor, because we're going to receive a certain dollar amount each year. So from years 1 to 5, we're going to receive our cash inflows, or we're going to receive cash of $437,500. So we need the present value of that, but we need the annuity factor, and that annuity factor at 10% is 3.791, because 10% is our required rate of return. So we take the present value of that. Our present value of annual net cash flows is $1,658,563. The salvage value of equipment is $250,000, and that's going to happen at the end. So what's the present value of $1 5 years from now? It's $0.621. That we take multiplied by the $250,000, and that gives us the present value of that $250,000. Working capital released. We're going to release working capital at $450,000 in the future. 5 years from now. What's the present value of $1 5 years from now? It's the 0.621. So we multiply the 0.621 times 450,000. We get 279,450. Then we're going to take our actual cash outflow now, which is investment in the equipment and the working capital needed, and that's the 1.436, or the 1,436,500, and the 450,000, and then the significant scheduled maintenance. That's in year 3. What's the present value of $1 at a 10% factor? 3 years from now, it's 0.751. So we're going to multiply the 0.751 times the 30,000. That gets us 22,530. Add up all those present value cash flows, and we get positive cash flow of $184,233. So this is an acceptable project. We get positive cash flow. All right. So in the given information is that our required rate of return is 10%, and where are we getting these present value factors? We're getting them from a present value factor table. I went and looked up all these present values. In your accounting book, in your financing book, you have a present value factor table. In that, or in your finance book, whether or not you have the table in front of you during a homework problem or an exam, if it's not in front of you, it should be given. And this is how you use it. When it's cash flows per year, you need an annuity factor, and when it's a cash flow at the end of, or a cash flow in a certain period of time from now, you're going to factor $1 at that point in time at the given discount rate. So the present value factor is a concept that we also learned in financial accounting. It's going to be present here, but know that the present value factors should be you should be able to obtain those from a present value table. So in these examples, I've already done that for you. I found them, and so we're going to assume that they're given. But in a homework problem, you may have to look them up, and in an exam, you may have to look them up. But either way, you're going to be given a table. Nobody's going to expect you to calculate a present value factor. It would be impossible by hand. So it's either going to be given in a table or given in the problem. Let's go to 2. Net present value method. HMS Round Belly Inc. has been offered a contract to supply Newport Sailing Club 14-foot sailboats for their private sailing lessons. Round belly shareholders require a return on capital of 15% for these types of contracts. The contract is for 3 years, and management has gathered the information in the table below based on the discounted cash flows. Should round belly management accept the contract? Okay, so now we're going to follow these green boxes for 2. The cash flow information from the given is given here. We got cost of sailboats is $375,000. The working capital required is $50,000. Replacement parts to be provided in year 2 are $90,000. Salvage value of the boats after 3 years is $20,000. Annual net cash flow is $175,000. All right, let's put that into our present value table, or present value what we need to, and let's look at whether or not we have positive cash flow. Cost of sailboats now is $375,000. That's a factor of 1 because it's today. We need to pay that now. Working capital required, we pay that now, so that's a factor of 1. That's $50,000. And those are negative cash flows. Those are cash flows cash outflows, not cash inflows. Annual net cash inflows is $175,000 per year, so we need an annuity factor of 15% for 3 years. That's 2.283. Replacement parts to be provided in year 2, so that's year 2. We need the present value factor of $1 at 15%. 2 years from now, that's the 0.756. Multiply that by the 90,000. We get a negative, cash outflow of $68,049. Salvage value of boats after 3 years is $20,000. So what's the present value of $1 3 years from now at a 15% rate? That's 0.658. Working capital released, we're going to release the working capital 3 years from now. That's $50,000. It's at the same present value factor as the salvage value. Add up all the inflows, outflows, and we get a negative cash inflow, a negative net cash inflow, and so that's an unacceptable project. Moving on to number 3, we're going to go through these brown boxes. The total cost approach. HMS Round Belly Inc.'s management is currently reviewing the productivity of certain assets. Management has noted that the aluminum form press machinery is very old and not running efficiently. Round Belly is analyzing 2 alternatives to improve the efficiency of the machinery. 1, refurbish the old equipment, or 2, remove the old equipment and install a new machine. Management has gathered the information in the tables to the left. For this type of project, management requires a 9% rate of return. Which alternative should Round Belly select? Okay, so we're given some information up here in these sort of brownish boxes. The first bit of information is the old machine cost. To refurbish the cost of the old machine, it would cost $475,000, and it would require maintenance every year for 12 years of $65,000. The new machine cost would be $4 million today. The estimated useful life is 12 years. The salvage value is $110,000. Required maintenance in year 5 is $150,000, and the salvage value of the equipment is $50,000. Okay.